All right. Looks like we're ready to kick this off. Good afternoon, everyone. Thanks for joining me on how to value your brewery or value a brewery. We're just going to jump right in here. One thing I do want to say, if you have questions, go ahead and post them in the comments, and I will certainly try to answer them real time. The reason why I don't want to push them off until the end, I don't want people to get behind, get lost. The material sort of builds on itself as we go. So just throw your questions in the comments, and I'll try to answer them. And if I'm not, I'm sure Andrew will jump in and tell me to slow down. With that being said, we'll just move forward here. All right, so that's me. My name is Owen Sizemore. I am a senior manager in the valuation practice at Brady Ware and Company. Brady Ware is about 150 person CPA firm. We got offices in Dayton, Ohio, which is where I typically sit, Columbus, Ohio, Atlanta, Georgia, and Richmond, Indiana. Again, my specialty is valuation and litigation support. I like to tell people that I'm a recovering CPA and a recovering auditor. So this is where I spend all my time in valuation and lit support. My specialties are craft beverage companies, complex securities, and any type of valuation as it pertains to litigation. I am credentialed in valuation, and I've been in public accounting going on 10 years, which is kind of hard to imagine. That's my boss. That's Mike Stover. Mike leads the valuation practice at Brady Ware currently. Mike, however, is a founding member of Wing Brewery here in Dayton, Ohio. So he lit the torch for our brewery and craft beverage practice, and I'll be the one carrying it before too long. Mike is a partner at the firm. He's been doing this for a long time, so he's been a great mentor of mine, and I have him to thank for not just my valuation career, but really getting me into breweries. All right, so let's establish a very important principle right off the bat. When we talk about valuation, all right, we're really looking at it as a potential investment, right? So when we go through our work, when we go through our valuation process, whatever project we might be working on, we're always thinking, what is the risk of this valuation, the subject of this valuation? You know, what would the required return be? All right, we're always looking at it as though we are potential hypothetical investors in the subject interest. All right, so as we move forward, just keep that in mind, and that'll make a lot more sense as we get into some of the later slides. All right, so here's the process from beginning to end. And I love this slide because I think it lays out the steps nicely. One thing I don't like about it is I think it implies, and I didn't mean for it to, but I think it implies that valuation is a linear process, and it really isn't. We may go through and feel like we're ready to finalize, and all of a sudden we get to our sanity checks, which is just a industry jargon for quality control, and all of a sudden something doesn't feel right? The narrative, the story of this valuation just doesn't seem right, and sometimes we got to take a few steps back, maybe even go back to the analysis section and figure out if we missed something or if we just looked at something wrong. So great slide, but just know it's not necessarily a step-by-step process. All right, so with that being said, the first step in any valuation engagement is to define it. What are we doing? What are we valuing? Why are we valuing it? And what lens or standard of value do we need to look at this through? All right, so again, define the engagement. Why might you get a valuation? Why might you need one? Well, there's four main reasons, or four high-level reasons. One is a transaction, and we're doing several valuations for breweries right now for this reason, where some of the early investors are ready to be bought out and move on. Of course, if somebody wants to acquire a company or a brewery, or sell a company or a brewery, that would fall under the transaction reason. The next reason is taxes. So estate, gift taxes are common ones for breweries. Now, there's other tax reasons why you might need a valuation. They're not as common in breweries per se, but we see it a lot in when it comes to startups. We'll do what we call 409A valuations, which is a tax compliance valuation. You might get one to resolve a dispute. A common one is divorce. So we do a fair amount of divorce valuation work, not just for breweries, but for other industries as well. Or you could be fighting with a shareholder and it's time for somebody to leave. Obviously, you'll have to value the brewery for that reason, so whoever's leaving can be bought out. And then, of course, financial reporting, not usually a reason why a smaller brewery would need a valuation. Typically, if any company needs a valuation for financial reporting, they're usually of significant size. All right, so that's why you might get one. Let's talk about standards of value. First and foremost, and the most common, is what we call fair market value. Now, this is a term you hear a lot, but when it comes to valuation, and particularly compliance-driven valuation, it has a very specific definition. And that definition comes from the IRS. That's a lot of words. I'm not going to bore you with it, but that is the definition of fair market value per the IRS. The key thing to keep in mind here, the key terms in this definition, I'd say, are the hypothetical willing and able buyer and hypothetical willing and able seller, right? So we're always looking at it through a hypothetical investor's perspective when we talk about tax-driven or fair market value valuations. Other standard of value would be fair value. Fair value, the definition of it depends on why you're getting the valuation done. Depending on the state in which you operate, they may have their own definition of fair value. So that one's not as common. A lot of the times we're doing fair market value valuation work. And then there's synergistic value. Synergistic value really means, what is the value of this company or this subject interest or this brewery to a very specific person with their own specific investment criteria. Commonly, well, I don't want to say commonly, but I'll say when we're doing something for a synergistic standard of value, it's usually because someone's selling a company or buying a company, and they've engaged us to value that sale or that transaction for their specific purpose. Let's talk about premise of value. We have what we call going concern. Going concern essentially means that the assumption is that this brewery or this business will continue to operate. They're not at risk for defaulting on a loan and going bankrupt or going under or anything like that. Going concern tends to be, in fact, I don't know that I'm not sure I've ever done a valuation that did not use the going concern premise of value. But there's other ones out there. There's the orderly liquidation premise of value, and then there's the forced liquidation premise of value. Those are the definitions. I'm going to say most people on this webinar aren't as concerned with those premise of values, but if you want to talk about it more, by all means, reach out to me and we can dig into them a little bit more. All right. So again, we're still defining the engagement. So we talked about why we might get one, why we might get a valuation, what's the purpose of it, what are the standards of value, what are the premise of value, and then the next one is, what's the subject of the valuation? Are we doing all the equity in a company? Are we doing a controlling or non-controlling interest? Are we doing a voting or non-voting interest? We see a lot of these, especially right now with the estate planning that's going on. People want to transfer companies or ownership in companies to the next generation. They want them to get the economic benefit of ownership, but they don't want to give up control, right? So they'll transfer a non-voting equity interest to the next generation. Are we valuing an interest that's marketable or non-marketable? And we'll talk a little bit more about that later. Are we valuing a specified number of shares, a specific class of equity? This we don't encounter as much with breweries, but our practice in general at Brady Ware, not mine specifically, but our practice in general at Brady Ware does a fair amount of tech startup work. And for those of you who don't know, tech startups often have a lot of different classes of equity, and each one will have different voting rights, liquidation rights, things like that. Or are we valuing stock options and warrants? Again, complex security work, which I do a fair amount of. But all that's to say, there's a lot of things that can be valued when you're valuing a company or even a brewery. Still defining the engagement. What are the levels of value? And this sort of touches on the premise of value, or the standard of value, I should say, between synergistic and if you're comparing synergistic to fair market value. But the idea here is that if you're talking about a financial control value, and I'll give you an example. So let's say me, Owen Sizemore, Valuation Senior Manager here at Brady Ware, I happen to be sitting on a pile of cash, and I want to make an investment into a private company. And let's say I'm going to invest in someone who supplies Apple with plastic, right? Apple, most of us have Apple phones, but I'm going to invest in one of their suppliers. I'm actually just going to buy the company out. So I have no interest in that investment. I get nothing from it other than the fact that I want to put my money into a business and get a return on it, right? So my assessment of that investment opportunity is going to be more so of a financial control value. On the other hand, let's say, and let me back up on that. Financial control value is probably most similar in the context of this slide to what we just defined as fair market value, all right? On the other hand, let's say Apple is going to go out and acquire one of their suppliers. Now, again, like I said, this supplier of plastic to Apple, they're a profitable company, they're well run. It's a good investment for anyone, right? But for Apple, not only is it a good investment, period, but Apple's probably going to realize some cost savings, right? Apple's going to get some synergistic value out of acquiring one of their suppliers. So Apple's going to analyze this acquisition or this investment opportunity through what we would call a strategic control level of value. All right. Does anybody have any questions on that? And if you do, I can't see any faces, so I can't see people nod or not. But if you do, send me a note in the comments and we can take a step back here. All right, now, moving on. Okay. So we define the engagement. We know what we're valuing. We know why we're valuing it. We know what the standard of value is, and we know exactly what the nature of the subject interest is. The next step then is we would then start gathering documents, financial documents, all kinds of stuff, and we would get into analysis. Now, the analysis part of the valuation probably, if you break it down into steps anyways, is probably where we spend most of our time. But it's where we are going to spend the least time for the purposes of this presentation. The key takeaway is we just dive in, right? We really get our arms around where the company has been and where we think they're going to go. We do financial analysis, economic analysis, and industry analysis. On the industry side, we'll benchmark the subject brewery to its peers. We'll also look at economic drivers, the types of economic drivers that are most important for breweries. And then, like I said, financial analysis. So we'll look at ratios, margins on gross profit, inventory turnover, things like that. And the point is again, to get our arms around what the brewery is capable of and where they've been and where they're going, but also to create what we call normalized economic financial statements. In this process, we will likely, if they exist, we will identify some non-recurring transactions that were just one-offs and need to be adjusted out of the historical statements. I'll tell you, one of these that we're looking at right now for breweries and several companies that don't own their real estate is normalizing for rent. Companies in 2020, because of COVID, got some rent breaks. But we know that going forward, they're probably going to have to, they'll be expected to pay that rent, even though their landlords may have given them a break for 2020. That would be an adjustment that we would make in this analysis process. All right. So once we've gone through the analysis, and again, that's a big part of valuing of the valuation process. Once we've gone through that, then we'll start to dive into the valuation approaches. So we're just going to talk about all these three roughly at once here. So valuation approaches, there was the cost or asset approach. The cost or asset approaches is really just this. You take your subject brewery's balance sheet and you adjust the assets and liabilities to what their fair market values are. And the result or the net change to the company's equity is the value, is just that. It represents the fair market value of the company's equity. Now, the thing about the cost or asset approach is that it's generally not appropriate for operating profitable companies. The idea is that in operating and a profitable operating company is going to be worth more than the sum of its parts. It's going to be worth more than just what it has sitting on its balance sheet. And that makes sense, right? Because as breweries, you own a lot of things that are not on your balance sheets, but are extremely valuable, right? Your recipes, the fact that you already have a workforce in place has value. Your brand name, things like that again are off balance sheet, but we all know help you guys make money and help you be profitable and are therefore extremely valuable. 1 second here. We've got a question, comments. Facebook user says, when you mention normalizing for rent, can you expand on that as it might relate to calculating EBITDA? Sure, yeah. So to bring it back to a valuation I'm working on right now, brewery, their landlord at one of their taproom locations forgave a couple months worth of rent. So I think ended up in 2020 ended up being, I'll say $50,000 worth of rent. Now, this is a little debatable, but the idea is that in normal operating times, which I know is kind of hard to say with a straight face, but in normal operating times, your landlord probably isn't going to forgive you for $50,000 worth of rent, right? We assume that for the most part that COVID was a one-off thing. It's not going to continue in the future. Landlords are eventually going to expect you to pay the full annual or monthly rent. So in this example, that $50,000 that expense that's not currently in EBITDA, that would be a reduction to EBITDA because it wasn't priced in, right? There's $50,000 in expense that the company should have recorded, but they didn't have to because the landlord forgave the rent. So we would reduce EBITDA by that forgiven rent. Let me know if that doesn't make sense. Hit me again and I can come back to it. All right. So valuation approaches, cost asset. Cool. Cost asset, generally not appropriate for operating profitable companies. And the reason is most of the time there's going to be some things that are valuable to you guys that just simply are not reflected on your balance sheets. Next approach, the market approach. It's a process of valuing a company by comparing it to sales of similar breweries or companies. Now, similar requires judgment and experience, but the idea is that if you look at similar breweries, right? Let's say you pull a transaction list of 30 sales of 30 breweries that are similar to yours, and you look at the price for which those breweries were sold, and divide that price by different earnings metrics, right? Be it sales, net income, gross profit, EBITDA. What you're left with then is a multiple for each of these breweries and each of these earnings metrics. And when you look at that total population of these multiples, be it we'll say EBITDA multiple, because that's the one most people are familiar with, I think. When you look at these EBITDA multiples for this list of transactions of similar breweries, you take some measure of central tendency. I'll say average to make it simple, but we don't like the average in our valuation practice, but I'll say average. So you take an average of the EBITDA multiples of these sales of similar breweries, and the theory is if you've done it right and analyzed it right, that average EBITDA multiple from all those sales applied to your brewery's EBITDA gives you an estimate of the value of your brewery. Right? That's the market approach. And we're going to dive into that a little bit more. The income approach. The two main elements for the income approach are what we call free cash flow divided by a required rate of return, which is usually a reflection of the risk of your brewery specifically. And we're going to dive into the market and income approach more. Again, the asset approach, like I said, generally not appropriate, so we won't dive into it anymore. But certainly happy to talk about it offline or another time if you guys have any questions on it. So let's get into an example of a brewery valuation. We got Buckeye Brew Pub. As you can tell, we're from Ohio. We like our Buckeyes around here. All right, so sample balance sheet from Buckeye Brew Pub probably looks fairly similar to what you're used to seeing on any brewery's balance sheet. You got accounts receivable, you got inventory, prepaid expenses, equipment, and then liabilities and equity side, accounts payable, accrued expenses, probably a line of credit, and then most likely some long-term debt. All right, here's our Buckeye Brew Pub's statement of operations or income statement or P&L, whatever term you want to put on it. Again, probably similar to what you guys are used to seeing. Okay, so from our income statement or our statement of operations, let's calculate the various earnings metrics. We got earnings before tax, right? Plus our interest is our earnings before interest and tax, or our EBIT, plus our depreciation gives us our EBITDA. And then one that you might not be as familiar with, but is commonly used in valuation, particularly for smaller companies, is what we call seller's discretionary earnings, which is essentially your EBITDA plus your owner's compensation or your seller's compensation. All right, now, so back to the market approach. Like I said, the idea is that you gather transactions of similar comparable breweries, right? So you could be comparable in terms of barrelage, sales mix between distribution and retail, geographic location. You know, do we want to look at breweries in the same area as yours? There's a lot of different attributes for which you could determine if a brewery is comparable to yours or not, right? But the idea is set that criteria and then go out and find transactions of those breweries. Now, here's a sample, just a sample of one transaction, sample data from one transaction. And this comes straight from one of the databases that we have access to. And here's the data, right? This company was sold, or this brewery was sold for $150,000. So it might have just been the equipment. Here's what their earnings were, right? All these different metrics. As you can see, for this particular transaction, we didn't have EBITDA. And that's one of the tough parts about using the market approach, especially when you're using transaction data. You can use publicly traded companies where there's an abundance of data, but of course, most breweries, most of your guys' breweries, if not all of them, are not going to be similar to the Boston Beer Company, right? They're not going to be similar to Molson Coors. And so the market approach we're left with using most of the time is the transaction approach. And the problem with that is since the data is not necessarily public, this data you see here was uploaded by someone who was a participant in the transaction. And so sometimes the data is incomplete. All right. So, we have to use our judgment on how we handle that as valuation analysts. But again, this is just some sample transaction data to give you a sense on what we have access to and what we look at. All right. So here's the market approach sort of in action. So here's our subject brewery, or our Buckeye Brew Pub's earnings metrics. All right. And then here's some data that comes from our transaction sample. So we looked at a total of 202 transactions, right? And of those 202 transactions, all of them, all 202 had data for calculating a net sales multiple. Now I want to take a step back here and say, when you see MVIC, for the purposes of this presentation, that technically means market value of invested capital. Now, for the sake of simplicity, just assume this is really the value of the brewery that was sold. So when you see MVIC, just think sales price, right, or sales value. Oh, hold on. Got another question here in the comments. All right. Question is this: is there a place to search for comparable sales to figure out multipliers or multiples that would be accessible to lay people like us? And it says, maybe I am looking in the wrong spots, but it does not seem easy to find publicly available data on small breweries. And it seems like the smaller you are, the more unique your situation is, and thus it's hard to find a comparable transaction or comparable situation. Preach, right? So our transactions come from three places: a service called BVR Deal Stats. We also use S&P Capital IQ, and then we use a resource called Tagnify. Now, BVR Deal Stats, most of that data, if not all of it, is uploaded by parties who were somehow involved with the transaction. So you won't be able to get access to that. Now, S&P Capital IQ and Tagnify, I believe most of that is actually public information that our resources go out and aggregate. And that's essentially what we're paying them to do. We're paying them just to aggregate that data. So I think the data is public, but it's very difficult to aggregate all of it on your own. So with that in mind, if you'd like to look at some transactions, we actually, and I was working on before I jumped on this webinar, we actually do maintain a database that we get from our three sources, and we have it. We can bifurcate it by all kinds of different size metrics and things like that. So if you want to talk about getting some multiples and taking a look at an analysis for your particular brewery, let me know, and we might be able to help you out on that. But yeah, to answer your question, it is tough to go out there and find public data without subscribing to some type of service. All right, so back to our market approach here. So like I was saying, when you see MVIC, just think sales price, the value of the brewery that was sold, right? All right, so of our 202 transactions, we computed these various multiples. I'm just going to focus on EBITDA because I think an EBITDA multiple is a term most of us are familiar with, or we are most familiar with. So of these 202 transactions, only 158 had data, the data needed to calculate an EBITDA multiple. Here's some statistical analysis. I'm not going to bore you with that stuff, but the point is when we go through this process, we really try to understand the statistical viability of the data we're analyzing. All right, but back to it, and again, let's just assume averages here for the sake of simplicity. The average EBITDA multiple of these breweries, and I want to put a word of caution out here. Don't look at this and assume that your brewery is worth 3.69 times EBITDA. All right, this is just an example. We cast a wide net here for the sake of having as much data as possible for the purposes of this presentation. So please do not go and tell people your brewery is worth 3.7x of EBITDA. All right. So that in mind. So of these transactions, the average EBITDA multiple was 3.69. We go through a weighting process. It's a mix of qualitative and quantitative of the various multiples that we multiply. But for our Buckeye Brew Pub example, our EBITDA is roughly 317,000. You multiply that by our EBITDA multiple, and using the EBITDA multiple metric of valuation, it tells us our brewery is worth $1.172 million. Now, again, we did a bunch of multiples here, but I just want you to get your arms around the mechanics of how this works, right? So from our multiples, we'll take some type of average, or I'll say a measure of central tendency, and of course we'll analyze the range of them and things like that. But on a weighted average basis from all these various multiples here, right? The weighted average basis, the value of our brewery is $931,000. Right? That is the market approach in a nutshell. Of course, it's a lot more complicated than that, but again, just want to give you a sense on the mechanics of it and the theory behind it. All right. So we're going to get into the income approach now. This is the basic formula for the income approach. All right. You have earnings, and we're really talking about free cash flow, but when people think of earnings, they usually don't think of free cash flow. They usually think of EBIT, EBITDA, right, net income. But the formula, the theory, you ultimately have to get to what your free cash flow is. All right, so you have earnings, 1 plus your growth rate, times 1 plus your growth rate, divided by the required rate of return minus your growth rate. Now, when we talk about required rate of return, there's some terms that are roughly interchangeable with that. One is cost of capital, or weighted average cost of capital. You might hear discount rate, capitalization rate, which the algebra's got to change a little bit between the two. But again, they roughly represent the same thing. But at the end of the day, what all these represent is an assessment of risk in the subject investment. That's important to keep in mind. All right, so let's get into the income approach a little bit more here. Like I said, all about free cash flow and rate of return. Calculation of the rate of return for us anyways. And there's a handful of ways to do it. And I think it's important to note here that there are some people who spend their entire careers. We're talking people with PhDs in finance or economics or math or whatever, spend entire careers studying rates of return. So it's probably the most sensitive and subjective area of valuation. All right. But I'll tell you one way of doing it, and the way that we typically do it is what we call a buildup. So we just start with the most basic rate of return, and we call that the risk-free rate. What is the risk-free rate of return on the safest investment, which traditionally is viewed to be U.S. Treasury bonds? And we start with that, right? I believe as of 8/31, whenever I put the slide deck together, it was the rate of return on Treasury bonds, 10-year Treasury bonds, I believe, was 1.31%. Now, from there, we ask ourselves, all right, to move from Treasury bonds into large, relatively safe, publicly traded companies, what additional return will we require? Historically, that you're looking at something around 9%. Now, we know that most breweries and most companies that we're going to value, not all, but most companies we're going to value are not the same size as large publicly traded corporations. So then we have to ask ourselves, all right, what is the additional rate of return to go from large publicly traded corporations to the smallest or small cap, right? Small cap companies, small publicly traded corporations. And there's an additional layer of return that is built up onto where we're currently at from there, right? And then from there, we ask ourselves, okay, once we have this sort of benchmarked rate of return, what additional rate of return would we require as a hypothetical investor to invest in our subject company or our subject brewery, right? And as we all know, as risk goes up, so does the required rate of return. There, you can pretty much view them as synonymous. But as risk and rate of return goes up, your brewery value goes down. So you got to ask yourself, what are the risks in your brew pub, the risk in your brewery? Well, they're relatively similar to the risk of any small business or any business, really. What if you have key person risk, right? Well, what would happen to your brewery if you lost your head brewer or your head chef? Are you, as the founder and owner, are you doing too much? Are you not delegating? What would happen to your brewery if something happened to you, right? We call that a key person risk or what we might call a key person discount. Did a new competitor just come into your geographic market, and are they going to start taking your taproom market share, right? You're not listed on here, but do you have an underperforming distributor, which I think I'm sure some people on this webinar can relate to? What's your local environment, right? Do you not have access to adequate capital to fund growth or fund, expensive repairs and maintenance that maybe you haven't budgeted for? And then, of course, regulatory, right? So regulatory is a risk for pretty much all industries. It changes by industry, of course, but again, certainly a risk for alcohol-based companies. All right, so still staying on the income approach, and again, going back to that formula in the previous couple of slides, talking about earnings, growth, and required return. So let's talk about growth. What growth have you experienced historically? What growth might you be able to achieve going forward? Are you going to invest in a new tap room? Are you looking at some pretty profitable or at least valuable distribution relationships? What is the capacity of your current brew house? And again, available capital. Do you have the capital available between equity investors or lenders to fund this growth? All right, so looking at our cost of capital, or weighted average cost of capital, like I said, we kind of went through this step by step: risk-free rate of return, equity risk premium, size risk premium, then unsystematic risk premium. And another term for that is company or brewery specific risk premium. So the risk unique to your brewery. And you add those up. And what we're really saying here is that your hypothetical equity investors would require, or I'll say Buckeye Brew Pubs, hypothetical equity investors would require a 26.16% return to make an investment into Buckeye Brew Pub. Now, we all know that businesses and breweries are not just funded by equity usually. A lot of times there's some debt involved. So your debt is a part of your required rate of return. What rate of return are your lenders requiring, right? Borrowing rate, we all know this changes, but we use 5% for this example. And then it's a matter of, and then of course you get a tax break for the interest expense deduction. And it's a matter of what is your mix of funding your brewery with these two different funding types or funding sources, right? Then you multiply those together by the relative weight, and you get what we call your weighted average cost of capital. Again, discount rate, capitalization rate, they're derived from roughly the same thing, which is this weighted average cost of capital. Minus your growth rate, you get your future earnings capitalization rate of 10.44%. Times that by 1 plus your growth rate. And again, you're kind of getting some nerdy finance stuff here, but it's helpful to understand the mechanics. Times your future earnings cap rate by 1 plus your long-term growth rate, and you get your historical earnings capitalization rate. All right, going back to this formula here, just a refresher. So earnings, we're talking about free cash flow. So how do we calculate free cash flow? This is the formula for it. Start with your net income and then add back non-cash expenses like depreciation, amortization. Subtract out, and this is important, your capital expenditures, right? We all know that if you don't invest in equipment, eventually you're not going to be able to survive. So that cash has to be spoken for. And then investments into changes in working capital, right? We all know that you're always going to have some cash tied up in inventory sitting in your brewery. And then some adjustments for some interest expense and preferred dividends. And you get to what we call your free cash flow. Now, this is the free cash flow. This particular formula is the free cash flow to your debt investors and your equity investors. So here it is in action, the income approach, right? We talked about growth and required return and risk. We just walked through the formula for free cash flow. Here is a capitalization of historical cash flow for Buckeye Brew Pub. Same thing, right? Start with our EBIT, earnings before interest and tax. Back out our estimate of income taxes, cash flow adjustments like we talked about for working capital, depreciation, amortization, and capital expenditures. You get your free cash flow. Here's your capitalization rate, and here's the value of Buckeye Brew Pub. Again, very basic. It gets a lot more complicated than this, but just a very basic measure of value using an income approach. Again, refresher on the formula because this is important. Sorry about that. Hold on a second here. My mouse is not complying with it. Okay. All right. So want to drive home the point here in how much a change in the risk or required return can impact the value of your brewery. So here we have a capitalization rate of 10.24%. A 2% change, right? A 2% change with this level of free cash flow makes hundreds of thousands of dollars of difference. And let's say perhaps that change was because the hypothetical investor or your valuation analyst thought that a particular brewery, this brewery down here, was more risky because, say, they didn't have management depth, right? I mean, it could be that simple. So it's important to keep in mind this required rate of return and the growth component of it can have substantial impact on value. All right. So we've gone through, we got a preliminary value of the company. Now it's time to look and see if we have any other issues for discounts or premiums. The two most common ones are what we call a discount for lack of control or a discount for lack of marketability. Now, these areas they're subjective. They're quantifiable to an extent, but but everything in valuation and making an investment decision requires judgment, right? But the idea for the discount for lack of control is that a 49% interest in a company, therefore a minority interest, on a pro rata basis is less than a 51% interest that actually has control, right? And there's all kinds of studies out there that that can prove that, or at least illustrate that theory. I'm happy to share that with you guys, but I won't go into any deeper than that. It's just the point. The key takeaway is a non-controlling interest on a pro rata basis or a per share basis might make more sense, is worth less than a controlling interest. The other common discount is what we call a discount for lack of marketability. The idea is that a private brewery cannot be, the ownership in a private brewery anyway, cannot be freely traded or traded as easily as, say, ownership in the Boston Beer Company, right? If I own stock in the Boston Beer Company and I wanted to sell it, I could do it almost in seconds, if not milliseconds. Whereas if I own stock in Buckeye Brew Pub, right, and especially if I'm a minority owner, and I wanted to sell my shares, well, who knows how long it would take me to sell them, and I may not be able to sell them for what they're truly worth based on these valuation approaches. So we apply what we call a discount for lack of marketability. Now, again, plenty of studies out there that can illustrate that it's legitimate, and I can, if you guys, anyone ever wants to just talk about them, walk through them, by all means, contact me, and I'm happy to share that with you. But 2 discounts that you should know are out there. All right, so we walk through our discounts and premiums. We got a number, we feel good about it. We go through our sanity checks or our quality control process. And again, we might have to revisit some of this stuff once we go through our sanity checks or quality control. And then from there, we get to our value. So let's put it all together. Here's our market approach, our 2 values based on these multiples. We use the simple average here because it's just easy to explain. And then we got to weight our reliance on the market approach. This is subjective, and it changes from valuation to valuation. For this example, we use 33%. Then, of course, we have our income approach result. Here's our weight. You add them up, and we get to our weighted enterprise value of $1.178 million. Add our cash, subtract our long-term debt, and this is the value of our equity. And that's it in a nutshell. So a couple things I want to leave you guys with is risk. I think that's the most important thing. And I think risk in our society, particularly when you think about people celebrating the accomplishments of publicly traded companies, you never hear in the Wall Street Journal or whatever news outlet, you never hear an article saying the CFO at Apple successfully reduced risk, right? You don't hear that. You hear about, well, Apple grew earnings per share by this, or Apple increased revenue by this, or Apple, cut costs by this, whatever the case may be. You never hear anything about risk management. So what I would say is think about the risk of your brewery and go back to that list. And honestly, if you just want to have a conversation about risk mitigation, again, give me a shout. I mean, if you want to have a conversation about anything brewery valuation related, give me a shout anytime. I'll put my contact information up here. But think about risk. What are the risks in your brewery? Okay. And think about how you can mitigate those. All right. That's my contact information. Work email, and that's my direct line. Anyone, feel free to contact me anytime. Appreciate you guys coming out and let me get up here and run my mouth about brewery valuation. I love this stuff, so I can drone on and on. I'm hopefully I didn't put anybody to sleep. But again, thanks for showing up. Really appreciate it, and hope to connect with you guys more in the future.